There's something strange I noticed recently. My cousin, she's 26, works a decent job in Austin, makes around $60,000 a year, told me she finally had a little money saved up. Not a lot, about $4,000. And she said, I want to invest it, but I don't know where to start, and honestly, the market feels insane right now. And I didn't argue with her. I just asked her one question. How long has she been waiting to figure this out? She thought about it and said, about 2 years. 2 years of those $4,000 sitting in a checking account, earning essentially nothing. And in those 2 years, inflation quietly took a real bite out of it. She didn't lose money on paper, but she lost purchasing power. And that's a loss no one talks about clearly enough. My name is Daniel, and today I want to walk through exactly what I would do if I were starting from scratch with investing in 2026, not as a set of tips, but as a genuine thought process, the kind of thinking I wish someone had walked me through before I made my first move. Here's the angle that I think gets skipped over constantly when people talk about beginner investing. The biggest financial mistake most new investors make isn't picking the wrong stock. It's the time they spend doing nothing while they feel like they're being responsible by waiting. There's this psychological trap where sitting on cash feels cautious. It feels like you're protecting yourself, but what you're actually doing is losing ground in slow motion. Inflation in the United States has been running at levels that many younger people have never experienced before. We went through a stretch where prices climbed faster than wages for a significant portion of the population. And even when inflation is at the Federal Reserve's target of around 2 to 3%, your money sitting in a standard checking account earning maybe 0.01% is shrinking in real terms every single month. The math isn't complicated. If your money earns less than inflation, you are getting poorer, even when your balance looks the same. That's the hidden tax on doing nothing. So when someone says to me, I'm going to wait until things settle down before I invest, I understand the instinct. But what they're really saying is, I'm going to keep paying the inflation tax while I wait for perfect clarity that will never actually arrive. The market doesn't hand out welcome signs. It doesn't send you a calendar invite that says, great time to invest, RSVP now. The moment of clarity people is waiting for simply doesn't exist the way they imagine it does. Now, investing is a broad word. People invest in real estate, in gold, in their own businesses, in cryptocurrency. I'm not here to tell you those things are worthless, but when I think about where a beginner should place their first dollars in 2026, I keep coming back to one specific structure: low-cost index funds that track broad market indices like the S&P 500. And I want to explain why in a way that isn't just because Warren Buffett said so. When you buy a share of an S&P 500 index fund, you are not betting on one company. You are buying a small piece of the 500 largest publicly traded companies in America. That includes technology, healthcare, consumer goods, energy, finance, the full economic spectrum. Historically, this index has returned somewhere between 8 and 10% per year on average over the long run. That number has survived recessions, crashes, wars, pandemics, and political chaos. It's not a guarantee, but it's the most durable track record that exists in modern financial markets. The reason I prefer this over picking individual stocks as a beginner is simple. Individual companies can and do fail. A company that looks dominant today can be disrupted, mismanaged, or simply left behind by a shifting economy. The history of the stock market is full of companies that seemed untouchable and then quietly became irrelevant. When you own the index, you own the whole conversation, not just one voice in it. Companies that grow get a larger weight in the index. Companies that shrink get smaller or drop out entirely. The index is self-cleaning in a way that individual stock picking is not. All right, so we've established the why. Let me get into the how, because this is where a lot of people get stuck.
Opening an investment account feels more complicated than it actually is. In reality, it takes about 15 minutes if you have your social security number, a bank account, and a willingness to create another password you'll immediately forget. There are two primary account types you'll encounter as a beginner in the United States. The first is a tax-advantaged retirement account, either a 401k if your employer offers one, or an IRA that you open on your own. The IRA comes in two main flavors, traditional and Roth. The traditional IRA gives you a potential tax deduction now, and you pay taxes when you withdraw in retirement. The Roth IRA gives you no deduction now, but your money grows tax-free, and qualified withdrawals in retirement are completely untaxed. For most people in their 20s and 30s who are in a lower tax bracket today than they expect to be later, the Roth IRA tends to make a lot of sense. The second account type is a regular taxable brokerage account. There's no special tax advantage here, but there's also no restriction on when you can access the money. If you think you might need to pull funds out before retirement, or if you've already maxed out your IRA contributions for the year, which in 2026 sits at $7,000, a taxable brokerage account is the natural next step. Platforms like Fidelity and Schwab are well established, easy to navigate, and have excellent customer service if you run into something confusing. I'd recommend starting there. If this is making sense so far and you're realizing you've been putting this off longer than you'd like to admit, go ahead and subscribe so you don't miss the deeper dives I do on each of these topics. Now, back to it. Once your account is open and funded, the next question is what to buy. And here is where I want to be very direct, because there's a version of this answer that sounds exciting and a version that actually works. The exciting version involves picking individual companies, chasing trends, timing the market around earnings announcements. The version that actually works for most people is far less glamorous. Buy a low-cost index fund and keep buying it consistently over time. Two ticker symbols worth understanding are VOO and VTI, both from Vanguard. VOO tracks the S&P 500, so your money is distributed across those 500 large-cap American companies. VTI goes even broader. It tracks the total U.S. market, which includes thousands of companies across all sizes. A third option many beginners use is SPY, which also tracks the S&P 500, but has been around longer and has extremely high trading volume, which can matter in certain circumstances. For a beginner doing long-term investing, any of these is a solid starting point. The expense ratios on these funds, the annual fee you pay just to hold them, are almost negligibly small, often around 3 to 5 basis points. That's 3 to 5 cents per $100 invested per year. What I would personally do in 2026, starting fresh, is open a Roth IRA and immediately set up an automatic monthly contribution into VOO or VTI. I would treat it like a bill I pay to my future self, not something I think about or react to based on headlines, just an automatic transfer that happens on the same day each month, regardless if the market is up, down, or sideways. Here's the part of investing that nobody adequately prepares you for. At some point after you start, maybe 3 months in, maybe 6 months in, you'll open your investment account and see a red number. Your balance will be lower than you put in, and something in your brain will immediately start generating reasons why you should pull the money out, why now is different, why the thing you just read about in the news changes everything. I want to address this directly because the behavioral side of investing is where most people actually fail, not the strategy side. The strategy for a beginner is simple enough to explain in a single conversation. The behavior required to stick to that strategy through volatility is genuinely difficult, and nobody is immune to it. The S&P 500 dropped roughly 34% in about 5 weeks in early 2020. It dropped about 19% in 2022. These weren't small blips. They felt in the moment like they could be the beginning of something much worse. People who sold during those drops locked in real losses. People who stayed invested, or better yet, continued buying, ended up significantly ahead within a year or two in most cases. The reframe I find most useful is this. When the market drops and you still have years until you need this money, you are not losing. You are buying more of the same assets at a lower price. Each automatic monthly contribution during a down market buys more shares than it would have at the peak. Over time, this averaging effect smooths out the bumps in a way that makes long-term returns more consistent than any single entry point would suggest. The market's short-term behavior is noise. Its long-term behavior is the story. This question comes up constantly, and I think the honest answer surprises people. You do not need a large sum of money to start. Most major brokerages now allow you to buy fractional shares, which means if a single share of VOO is trading for $600, you can invest $50 and simply own a fraction of a share. You still participate in the same gains and losses proportionally.
The minimum barrier to entry into investing in 2026 is genuinely low. It's more of a psychological barrier than a financial one. That said, I do want to be honest about scale. If you're investing $50 a month, you are building a habit and learning how to be an investor, and that is genuinely valuable. But the math of compounding only becomes life-changing once the base gets large enough. If you earn an average of 8% annually on $50 a month over 30 years, you'd end up with somewhere around $75,000. That's meaningful, but it won't replace an income. If you can work your way up to $500 a month, the same calculation produces closer to $750,000 over the same period. The habit is the foundation, but finding ways to increase what you're investing is how you actually change your financial life. My personal suggestion, start with whatever you can genuinely commit to without it affecting your ability to pay rent, keep an emergency fund intact, and live a reasonable life. Then make it a goal to increase that amount by some percentage every year, either when you get a raise, when you pay off a debt, or when you reduce an expense. You don't have to solve 30 years of investing today. You just have to take one consistent step at a time and keep going. Let me bring this together into what I would genuinely do if I were starting right now in 2026 with a relatively modest amount of money and no investing history. First, I would make sure I had at least 3 months of living expenses sitting in a high-yield savings account before touching any investment account. Investing is a long-term game, and it only stays a long-term game if you never have to sell at the wrong moment because life handed you an emergency. That buffer is the foundation. Second, I would open a Roth IRA, specifically because I'd rather have tax-free growth compounding over the next several decades than a deduction I'll barely notice today. I'd fund it at whatever I could afford consistently, even if that number is modest at first. Third, I would set up an automatic investment into a broad index fund like VOO or VTI and configure it to execute on the same date every month. I would then make a genuine effort not to look at it more than once a month, because frequent checking of investment balances tends to cause anxiety that leads to bad decisions. Fourth, and this is the part that matters more than any ticker symbol, I would commit to continuing to learn, not obsessively, not in a way that turns into analysis paralysis, but consistently, over time, building a clearer picture of how money works, what risk actually means in practical terms, and how to think about my own financial future with more sophistication as the years go on. The investors who do best over a lifetime are rarely the ones who found the best stock. They're the ones who stayed in the game long enough for compounding to do its work. My cousin, the one I mentioned at the beginning, I walked her through this. She opened her Roth IRA on a Wednesday night, she set up a $200 monthly auto investment into VTI, and the thing she said afterwards stuck with me. She said, "I thought this was going to be harder." It usually is once you're inside it, but starting is actually the easy part, once you stop waiting for the right moment and realize the right moment was always just the one where you decided to begin. If this video helped you think about your own financial picture differently, I'd genuinely appreciate it if you shared it with someone you know who's been on the fence about investing.
And subscribe if you want to keep going deeper on these topics. I put a lot of thought into how I explain this stuff, and there's a lot more to cover. If you've been putting off investing, what's the one thing that's actually been holding you back? Is it the money, the knowledge, or something else entirely? I read every single comment on this channel.